Well, good morning and good afternoon, everyone. I'm Elliot Kallen, CEO of Prosperity Financial Group, and I'd like to welcome you to another episode of Meet the Expert. Exciting as always. I love doing these, and I'll tell you why. Because we interview interesting people that bring great topics, these days financial topics, to the surface. They're germane, they're topical, they're interesting. We want you to hear this, and today will be no exception at all. We've been doing this now for 4 years. We're in the top 2% of all financial podcasts. The best ways to reach me as Elliot, E-L-L-I-O-T, at prosperityfinancialgroup.com or 925-314-8503 or prosperityfinancialgroup.com. Reach out, ask questions, whatever you need to do. Today, we are talking with Greg Torretti from American Century. Very exciting what's going on. He's a New York or ex-New Yorker, lives in Connecticut now. Let's not hold this against him. Although if I could swing to get him some good New York pizza and New York deli, I'd be thrilled to do that. So Greg, welcome.
Thank you, Elliot. Thanks for having me.
Great. American Century is give or take a $300 billion entity out of the Midwest, just and they do a lot of value-based investing, meaning value, meaning core value. I don't mean value in the marketplace. But they are very associated with a hospital and helping kids, and they do some wonderful things there. And then his team runs $8 billion of municipal investments. So that's what this show is dedicated to. So if you're somebody that wants to get state-free money, federally tax-free money, and you want to know how do I do better with that, and am I just throwing my money away by getting less than I could in other places, but I'm gaining tax-free money, tax-free status, then we're going to answer that. So it has been a wild ride for tax-free income. It went from really good for a whole bunch of years to not very good. And then look what's happening. It's good again. All right. So let's first talk about what is municipal investing. Welcome first, Greg, welcome.
Yeah, thank you for having me, Elliot. Thanks for joining us.
I will try to pin you down a little bit on the food later on in the show. I'll get you my mailing address for that kind of food.
Absolutely.
Those people who know me personally, and I am somebody that I want you to know me personally. I like the very personal side of it. I'm not a standoffish guy. Is that we talk about food quite a bit, and we talk about red wine quite a bit. So those are subjects I always talk about with people because that's what I love, both those things.
Same
so
here.
Let's talk about fixed income. So why don't we talk about not just fixed income, municipal fixed income, tax-free fixed income.
Correct.
Let's define it and let's begin to understand it a little bit.
Sure. Yeah. Again, so within the world of fixed income, a fairly large pocket is what we call to be considered to be municipal bonds. So these are bonds, or effectively they're loans at the very basic, issued by states and local governments. And over the life of the bond, investors will receive income or coupon payments. And this income, as you were alluding to, Elliot, is exempt from federal and sometimes state tax exemption. For example, if you're a California resident and you purchase a California-based domiciled municipal bond, you will be exempt from federal as well as state income taxes. And given the fact that tax rates are relatively high, especially for in-state residents in California, that's more so. These bonds, the income exemption aspect of them make them really appealing, especially to folks in the higher tax brackets where it makes much more sense to own them. Excuse me. So
I was going to say, let's define a little bit what that means, because when I think of municipal bonds, we're thinking of a city like San Francisco or New York. And,
right.
Just that would scare the heck out of me, those two cities, although I don't think they're going to default. I hate the way they run, or Chicago in there. And whenever you want to do these big cities are in major trouble, but the market is way broader than just municipalities, isn't it?
Yeah, correct. So you mentioned a couple of the poster children for sort of bad financial management over the years. That's certainly true for Chicago and increasingly San Francisco. But as you alluded to, the fact that the municipal bond market of $4 trillion is actually quite diverse, and there's a lot of breadth to it. So you alluded to we divide the world into two. There's general obligation bonds, which can be both state and local. So the state of California issues debt to fund their expenses and their expenditures. Different cities and towns also issue debt. Those are called general obligations. So it's backed by the full faith and credit and the ability of those states and local governments to raise taxes effectively and to levy taxes to pay for those to pay for the bond coupon and interest payments. The other part of the muni world, which is a lot bigger and a lot more broad and where we find more value, frankly, over time, because it's a little bit less trafficked and there are fewer people looking at it, are areas like bridges, toll roads, schools. You and your listeners touch municipal bonds very much every day in your life, whether you're riding a subway, driving on the freeway, bringing your kids to school. Even more so nowadays, there are various sectors that entail public-private partnerships. So if you live in a new community in the Bay Area that has a cul-de-sac and they build out the roads and the sewage and things like that, the infrastructure, some of those might be financed by municipal debt. So it's a very dynamic part of the market. It's a little sleepy part of the market too, but there are a lot of areas that, again, we touch and feel every day that people probably don't realize that are helped and financed by municipal bonds. Hospitals are another area that people probably don't realize that municipal bonds might pay for them, or a park in their community.
So the Federal Reserve Board touches the municipal world indirectly. How does that happen? What do they do? And whether it's good or not, what do they do that make municipal bonds a place I'd want to be?
Frank, I mean, so from the sense that they are setting the short-term interest rate
They're changing interest rates around.
Yeah.
They're slowing the economy. They're putting
Right.
cash into the economy. They take action all the time, and it
Right.
changes the way people view municipal bonds versus, I'm not going to do that. I'm going to put my money somewhere else.
Correct. Okay, right. So from that perspective, it is what we consider the risk-free rate, the reference rate, where you can kind of put your money with very little risk and sleep at night, and otherwise known as cash for a lot of us, right? That's been appealing to people because the Fed has raised rates most recently to 5.25, and I think a lot of you can find some opportunities, whether you're looking at CDs or short-term bank notes, things like that, in that ballpark. Municipal bonds, though, are fairly appealing, even though the overall rate of interest might be lower than the Fed funds rate, as you alluded to, Elliot. It's the tax exemption that's the benefit. So, for example, you have to do a little bit of bond math to go through this and for it to make sense. But say you can earn 3% on a California municipal bond and an after-tax yield, that's actually equivalent to more like a 6% yield on a taxable bond like a treasury or something like a CD. So really, while the Fed has increased rates, and you might say, well, I can park my money in cash. You really have to think about the overall impact on an after-tax basis when you're investing in our market, and then it becomes a lot more appealing for people.
So just to put your math together that you just did, Greg, because I
Sure.
know
Yeah. Sorry.
we're talking a lot of math. What
Yeah.
Greg just did is he said, well, if you take the highest federal tax rate and you take the highest California rate and you put the medical tax on top of that, you're pushing 50% all in.
That's right.
And so if you're getting a tax-free yield, tax-free payout of 3%, and you're in a 50% bracket, then you double it to get what it would be if you were paying full taxes, and that's 6%. So you're making 3% than you were putting your money in the bank at 5%, because it's equivalent to 6. So I don't want to get confused and get in the weeds of math, but that's how you figure this stuff out.
Yeah, no, thank you for that context. Yeah, I didn't mean to gloss over that, but effectively, I didn't mean to throw, oil, salt in an open wound, but folks in California are paying 13% plus 38%, so it's north of 50, bordering on
it's hard to get into
Scandinavia, but for back of the envelope, we say double, right? So if you can pick up 3 and change on a muni, you double that to six and change.
Yeah, and I don't think taxes are going down, at least in the state of California or New York or New Jersey or Illinois, anytime soon.
That's right. That's right.
So how does this compare with the rest of the world?
In terms of where we are as a country, obviously there's a lot of a lot of headlines out there that'll tell probably on the extreme on one side or the other. I think we're actually doing fairly well compared to other countries, whether it's in Europe or compared to our partners in Asia, or other economies in Asia, such as China, for example. We have our issues with inflation and high debt levels. I think a lot of it caused by COVID, whether it's the inflation from the spending that took place. But when you look at other major economies, Europe's it's export centric. For example, countries like Germany, they do manufacturing, their service sectors have contracted, and really they have other issues with rising interest rates, high inflation. They also have somewhat slower growth too. Similar situation in UK, where inflation is elevated and interest rates are high. Ditto for Asia. The Chinese economy, read more and more so the issues in the property market in China, where I think no one's really knows that the full knock-on effects yet of that, how that's going to play out. They've tried to do, monetary and fiscal stimulus, but that's really failed to ignite growth. So despite the dysfunction in Washington, we're still better off on a relative basis. And for that reason, we're perceived to be as a safe haven, whether it's, the dollar itself. I think what I hear sometimes, and this is sort of a cute saying, is that some might describe the U.S. as the cleanest dirty shirt in the laundry. So what it says is we're a little bit, if you're being chased by the shark, you don't have to be faster than the shark. You just have to be faster than the guy next to you. So that's a little bit of a way to describe the U.S. economy as being a little bit better off than most other developed countries.
Sometimes I feel like the best looking horse in the glue factory instead.
That's one too, yeah.
So interest rates now, Greg, are more or less peaked, at least for the moment. And they've been rising. They had a meteoric rise and the fastest rise in interest rates in American history. And that just destroyed 2022, basically, and part of 2023. But now we're topping it out, and there's a likelihood, I don't have a crystal ball, there's a likelihood that by the end of this year, interest rates may soften because the economy may soften, and it might be time to begin to lower interest rates. That generally leads to a bull market in bonds, because we've had a bear market for a few years now in bonds. So how does that affect the muni market?
Good question, and we really think that's a catalyst and a positive in two different ways. So for munis, the first is that we typically do have an intermediate to longer duration. So duration on most municipal, the market broadly is around 6 or 7 years, if you were just to kind of pick an index or the broad market. So what that means, to your point, is if interest rates do fall, which a lot of firms, ours included, are anticipating in the back end of the year, you'll get some benefit in terms of a price appreciation. So as rates go down, bond prices rise. So that's one benefit if we do see rates drop toward the end of the year. The other is the high quality nature of the asset class. So they're going to be rates are going to be falling, we anticipate, due to the fact that there's an economic slowdown coming. This is in our view at American Century. And so when that happens, there's considered to be sort of a risk-off environment. And munis, other than U.S. Treasuries, are considered to be the sort of the second safest place you can be overall and sort of broad investment. So one that's got that strong credit quality and history of paying you back, and even some of the riskier parts of the muni market have a strong history of paying you back. And then again, like as I mentioned, you get that benefit of owning some duration when rates fall. So a good place to be if we do experience some volatility and some economic softness.
Okay, so on that same note, maybe 4 of the biggest state issuers of bonds would be California, New York, New Jersey, and Illinois. And they are the states that are having the fastest exodus of high net worth people in the United States. And they're going to places like Texas and Florida and Tennessee and so forth, and Nevada. They're going to those places. That has to affect the ability for revenue to be collected to pay these bonds, because that's how it works. So I want to make sure everybody understands, as we talked to Greg from American Century about the municipal bond market, is that when a bond issuer, a hospital or municipality says we're going to raise $30 million or $300 million, they're counting on a fact, and we voted it in California. So you can't say that nobody knew what was happening. They have to raise that principal maybe over the next 5 to 20 years back, and they're going to pay a reasonable amount of return to the investors. But if this tax base is shrinking because the money is leaving, that could have a challenging impact. I don't want to say adverse, but challenging impact on the results. What do you think of that? And then go ahead, now finish that, and I'll do a follow-up question with you.
Yeah, that's absolutely true, and that's something we're watching in the market. And there's other issues too that have been chronic in the market. Things like unfunded or underfunded pension liability. So that kind of goes hand in hand with firefighters, teachers, leaving Illinois and going to move to Florida, for example, right, for retirement, and that check goes down to Florida. So it's a double whammy of not only you paying people a lot of money and in retirement, but you're also sending the money to a different state. So you're not getting that really multiplier effect and benefit to the home state, a couple states that you mentioned. So that's real. Unfortunately, while it's a problem, it's a little bit of a slow moving train wreck where we've seen these demographic trends for years and years, and there has been some planning for them. I don't want to say that we're Pollyanna-ish and we have rose-colored glasses and we think that everything's going to be rosy, but we are mindful of them, and I think it's reflected in the fact that you can earn a higher yield on states like Illinois and in some pockets New Jersey. The other thing I would say too is from an investment perspective, that allows us to look. We have the ability to look outside those states, so we are overweight to some of those others. We're underweight to California. We're underweight in many cases to Illinois, as well as New York and New Jersey. So as active managers, we can avoid some of those what we consider to be slower moving train wrecks. I don't want to give anyone that scare anyone into thinking that there's going to be a default in any one of those particular states, but over time, as you mentioned, the demographics are untenable and unsustainable.
So that means that money management versus an index is very important, isn't it?
Yeah, absolutely. And again, that you mentioned too, so they're larger states and they borrow a lot, that they're most indebted. So they're the biggest percentage of, if you could just go buy a passive solution or an index option, you're going to get the higher, a pro rata, a market value that's more representative of these more indebted states and municipalities.
So in California, on the downside, because I know there's less than a 1% default rate, but in California, we were blessed to have Stockton and Vallejo, two cities that filed bankruptcy and defaulted on their bonds. What happened to those bondholders?
Yeah, so in those cases, there typically is there are various bonds underlying them over various maturities, and in those cases, some of those investors or most of those investors got a lot less money, but there is a recovery value, what we consider to be a recovery value, and then the process allows investors to claw back some money from their investors. So it wasn't a total loss, yet investors typically don't end up being made whole. I would say that those two are, while they're probably top of mind for many of your viewers, and they're local to the area, they are an anomaly, and they do overall, even the riskiest parts of the municipal bond market default on average of less than 1%. And in those cases, when they do default, people tend to get their money back. So Stockton and Vallejo are certainly cases to be wary of, and they are also in a moral hazard type of way, a good thing for the muni market. If you think about, unfortunately, the ramifications of filing for bankruptcy, that tends not to go well for those cities and towns over time, right? You don't want to be delinquent on your debt, because it then means that you can't go back to the municipal bond market and borrow from investors. And so while it might be perceived as a short time or a best solution or a best option for, again, Vallejo or Stockton, over time, not going and being able to tap the market at low interest rates has really put a lot of strain on those communities from the perspective of hospital, teachers, firefighters, and it could even have a sort of a negative feedback loop of impacting property values, et cetera, et cetera. So a cautionary tale. The market sniffs that out, and over time, I think cities and towns have realized that paying their interest and their coupons and their principal, while painful, is a lot better solution than filing for bankruptcy. I just want to make sure I just convey too that again, anomalies, it doesn't always they're more of the exception than the rule.
Great. And we're talking with Greg Torretti of American Century, a large multi-billion dollar entity in Kansas City, and he's on the East Coast managing an $8 billion muni world. And I'm Elliot Kallen, 925-314-8503 or www.prosperityfinancialgroup.com. A few more questions, Greg. This has been great for people that like munis, trying to get more in that market. This is great information. So some people talk about how long is this bond going to be around for? In other words, what's the duration? Should I buy short, medium, or long? How do you define that, and what does that mean?
Yeah, so duration means a couple different things. I think that the most, from the bond side of it, from the investment side, we're we're bond geeks, and has what we think of it as has the impact that interest rates bear on our investment. So from our perspective, when we say a duration of 5 years, if interest rates go up 1%, the price of the bond will go down 5%. So it's also a measure of time as well. So it's a measure of interest rate sensitivity, and it's also a mention of time, right? Duration. So how long on average does it take for you to get paid back from this particular investment? So it means volatility as well as time to get paid back in the bond world. That's how we think about duration.
So which is better? Short or long?
Oh, sorry. Yeah. Short long. Right now our view is we're in the intermediate part of the market. So for us, that means about 6-year duration. We've been extending our duration a little bit longer. And by that, I mean maybe to 6.5 years. So on the margin, we've been extending duration. And the reason for that is, as I think you led in with a question earlier, which is, or made it more of a statement rather, which is that interest rates are likely going to trend downward over the next year, call it 6 months the next year. And with that, that means the more you extend duration, right? As I just mentioned, the definition of duration, interest rate sensitivity. If interest rates go down, the price of our portfolio and the price of our bonds will go up. So the longer we extend duration, we think we'll benefit from a drop in interest rates.
Okay, that's good to know, and we could do all of it. So you could buy a bond. You can also buy mutual funds and ETFs with bonds, bond funds. What's the difference, and why would I want to buy one over the other?
Yeah, so bonds. So there's three. You have three. You have bonds, bond funds, and ETFs. Is the three you wanted to kind of compare?
Right.
Okay. There's a lot of different variables. I'll just kind of maybe break it down for a couple different things, like liquidity. There's diversification. There's how much you're going to invest, and then there's also a degree of customization. So you really have to implore folks to work with you, Elliot, to determine their liquidity, diversification needs, their minimum investment, and how they want to customize. So if it's liquidity, for example, a bond mutual fund or an ETF is probably the best way to go. So they can buy and trade that ETF or that mutual fund either daily or intraday to get their money back or to invest. So that's appealing. In terms of diversification, we mentioned Stockton and Vallejo. Yes, if you held all of Stockton and Vallejo, you didn't do pretty well. You didn't do very well. But the key is you talk to your clients about is the benefit of diversification is that there are many, many dozens of positions that diversifies the risk that you might have to one particular bond. Diversification from mutual funds and ETFs are also very good. In terms of a minimum investment, most mutual funds and ETFs have a lower initial investment threshold, making it easier for individual investors to contribute over time and really build their investment. Individual bonds, on the other hand, if you're going to go out and buy a bond, it's typically very expensive to do that because you're trading with a broker who might not be very nice to you as a particular individual, and or it's very difficult to find bonds sometimes with the denomination or a value less than 50K. But then on the flip side, in terms of customization, it might make sense for folks to work with you, Elliot, if you offer individual bonds or you can help them procure individual bonds so they can really target whether it's a specific horizon, a specific yield, and a specific risk profile that they have in mind and come to you and give you all these criteria. You might be able to help them build a portfolio with individual bonds. So again, really depends on those. I'd frame it in terms of those main needs that you might have as an investor.
So I want to just continue that for a moment because there's something called SMAs or separately managed accounts, municipal bonds. I'm assuming you do that too.
We could, yeah, we could.
Yeah. So client comes to me in a high tax bracket, $1 million, $5 million, $10 million, $20 million, $30 million to invest, and we've decided that the municipal market is a place he or she needs to be. Of course, and I can go obviously to a Schwab back room and begin to look at bonds. And then all it would really give me yields and yield to worst and yield to best. And there's some numbers that I can look at and the rating and so forth. But I don't trade bonds every day. And you do. So what's the advantage of me not going to the Schwab or Fidelity back room and building this up versus bringing in an SMA like manager like you that does this every day and we work together on it?
Yeah, a couple of very good question. I think the answer, there's a couple of reasons. First of all, is really what you're good at in your time, right? And thinking about what is efficient for your time and what's the cost to do that. It's something you're probably not. That's probably not. One of your greatest skills, right? No offense to you, but you probably better spending your time elsewhere rather than going, on Schwab, for example, or another provider, looking at QSIPs, looking at risk, trying to determine what the risk of that particular bond might be, trying to, determine whether or not the value and the yield of that bond is reflective of the risk you're taking, and then really sizing the duration. We talked about the time horizon for a particular investor. So there's a lot of work that's entailed in that, and to offload that to a financial institution like ours is probably well worth your money in terms of basis points to have us do that risk, have us do the due diligence on that portfolio and customize that for you. It makes a lot of sense for people to really think about having that sort of outsourced to an investment advisor rather than doing it in-house. And there's other things too where we typically tend to get very good pricing because we're going to buy in larger blocks than you might. So even though you might have an investor with 10 or 12 million dollars, our funds are in the billions. So we tend to get sort of improved pricing due to the size and scale that we have in the market. So there's advantages that we have on our end that we can pass through to you and your investors.
Right. And I want people to know that, the average financial advisor in the United States is about 1% on fees, but in the muni market, it's not that. It's significantly less because if you're only making 3.5% on a municipal bond, you're not losing 1% to the advisor.
That's right.
So don't go in thinking that I can't afford the advisor. If the advisor's doing a great job, by far you can avoid them and they'll make you money. And they might say, it's time to sell that bond. Let's get rid of that bond. We're not holding it for 20 years until maturity. You're 70. Maturity would be a silly conversation to have at 70.
That's right. So point being, we're not just doing the due diligence up front when we purchase. It's a constant, continuous process where we're evaluating everything we own on a daily basis with in-house analysts, et cetera. So it's that professional management that you're getting access to for a fraction of the price.
Bond portfolios, Greg, when I take over bond portfolios and I see that you've got interest rates are dropping and you've got bonds that are selling at 106, or 105 at premiums, I'm selling them because that's as good as it's going to get. Let's make our money for the most part and take advantage of something new. So nobody's locked.
It's a lot of work though. It's a lot of work. Yeah,
it is. So quality wise, and let's end on this quality thought for a moment, Greg, because there is such a low default rate out there. So the difference of I want AAA, AA, single A, triple B, double B, high yield, unrated, because lots of hospitals are unrated. You just buy the entire hospital. One organization buys it. They don't need to go to a rating agency and pay that money to do that. Because, by the way, what happens for the consumer that you don't understand behind the scenes is that every time you hear about a AAA or a triple B, that company, that organization has paid money to a rating organization to do an evaluation and probably hired a Big 10 accounting firm, Big 15, Big 20 accounting firm, even though they're really called the Big 5, but they're hiring a top accounting firm to do the math. So there's a lot of cost that went into that lowers the rate because somebody's got to pay for that. And so sometimes high yield and unrated can just be a better deal for a consumer. And if there's such a low default rate, why don't we just do more of that?
Absolutely. Well, I mean, that's the thing. Because of the high cost to get a rating, the folks are automatically going to get a lower coupon and in most cases a lower return. So it kind of goes back to what we were describing before in terms of what we offer at American Century is that we have a group of professional analysts, portfolio managers, we have traders. So we have a group of people in-house who are following the market and who are able to take advantage of that knowledge that we have of the market, whether it's a hospital that's non-rated because they didn't want to go out and pay for that rating from S&P. And so whether it's a park, a school, a charter school, higher education bond, we are in the market assigning our own rating for those quote unquote non-rated bonds. So you can find some real good deals. You can also find some Vallejos and some Stocktons out there. So our job and what we've been pretty good at throughout the years is really identifying, the non-rated and doing the due diligence on our own. We don't just look at a rubber stamp from S&P or Moody's or Fitch. We all know that S&P and Moody's or Fitch, they do a good job generally, but they've gotten it wrong before. I don't know if any of you followed the housing market and the CLO market back in the 2008, 2009 period. They don't always get it right, and I call it, there's a little bit of an arbitrage where we can, as fundamental research analysts, our team can uncover some good deals in the high yield and the non-rated market that again might not have as many eyeballs on them.
So, Greg, I'd be remiss if I didn't ask you a closing question on risk.
Mm-hmm.
For people that buy municipal bonds, we know there's a 1% default rate, give or take or less. Is there any other risk that the consumer, the high net worth investor, should be aware of here?
I think we talked about interest rate risk. So there's always that outside, risk of interest rates going back up. So that's another one. The risk we're talking about for people in terms of like sort of black swans is, we're increasingly tense geopolitical situation here around the globe, and we could have things like cyber attacks, right? We have utility bonds are part of the municipal bond market. Hospitals are part of the municipal bond market. You're seeing increasingly on the fringes and on the margin, you don't see them publicized, but things like targeted attacks, cyber attacks, and that could hit any portion of our market or any portion of broadly the general investing market. But since we do operate in essential services, things like utilities, things like hospitals, education, we could be susceptible to something like that. I don't want to be fear mongering. I do say that munis are, in general, or particular, as I mentioned, very rock solid, long history. I think the last state that defaulted was Alabama, and that was during or Arkansas during the Great Depression, where they also had a hurricane come through. The Great Depression, it had something else happen. It was like the cataclysm, and that's the most recent example we have of a default from any state. So while there are risks in general if you're buying fairly high quality and or you're paying someone to do research on high yield and non-rated, you'll probably sleep pretty well at night. Hopefully better than you do buying crypto or global growth stocks or small cap stocks. So we like to be the sleepy part of the market and the boring part of the market in your portfolio.
Greg, this has been great. I've been talking with Greg Torretti of American Century. They just do a fabulous job on municipal investing. If this is something that you want to learn more about, then give me a holler at 925-314-8501 or prosperityfinancialgroup.com. It's been great, Greg. I want to thank you very much for being part of our show.
Thank you, Elliot. Nice to be here.
And folks, if you've got more information on any of our shows, they're on the website, Meet the Expert with Elliot Kallen, and there are 60+ episodes there with more to come. So have a great day, everybody. We'll see you again.